In this video, we will be going through all the tax reliefs and rebates that you can use to reduce your income tax in Singapore. Legally, of course. So let's start with the first one on the list, the CPF Cash Top-Up Relief. With this relief, you can reduce your chargeable income by topping up to $8,000 to your own CPF SA, RA or MA, and another $8,000 by topping up your family's member's CPF. So that's up to $16,000 of relief. To qualify for the family portion, you can top up your parents, grandparents or in-laws CPF. But there are a few things to take note of here. First, if you want to top up your spouse or siblings CPF to earn the relief, can is can, but they must not have an annual income of more than $8,000. Otherwise, you won't get the tax relief. The exception is if they are handicapped. In that case, the income limit does not apply. Second, topping up your children's CPF will not qualify for the tax relief. Third, any top-ups that qualify for the Match Retirement Savings Scheme will also not be eligible for the tax relief. For those who are not familiar, MRSS is a scheme where if you are above 55 years old and have less than the basic retirement sum in your RA, the government will match your top-ups dollar for dollar, up to $2,000 per year. So if your top-up qualifies for this matching grant, then you will not qualify for the CPF Cash Top-Up Relief. And lastly, the relief only applies if your top-ups stay within CPF's limits, meaning top-ups to SA or RA must be below the full retirement sum and top-ups to MA must be below the basic healthcare sum. Between topping up SA or MA, I prefer topping up my MA first. Since MA money is still very usable, you can spend it on vaccinations, hospital bills, day surgeries and even insurance premiums, while SA money on the other hand is completely locked up till you become old APET and old AMA. Next up, the Supplementary Retirement Scheme or SRS allows you to reduce your taxable income simply by contributing to your SRS account. For Singaporeans and PRs, you can contribute up to $15,300 a year, and for foreigners, the limit is higher at $35,700. With SRS, you not only get to enjoy instant tax savings, but you also get to invest and grow the money inside your SRS account. You can put it into stocks, ETFs, unit trusts, fixed income products, and more. Now, the higher your income, the more meaningful SRS becomes. For example, if your taxable income is $50,000, contributing the full amount to SRS will only save you about $885 in taxes, which is nice, but not really a lot. But if you're at the $120,000 taxable income, maxing out your SRS will save you $1,769. That is literally the cost of a short trip to Japan. Also, foreigners get an extra advantage here. Unlike locals who must wait long until age 63 to make penalty-free withdrawals, foreigners can make a one-time full withdrawal as long as it is done 10 years later after their first SRS contribution. Though, the tax rate that they are subjected to may vary depending on different conditions, and the SRS operator will withhold tax at a 24% non-resident rate. But IRAS will refund any excess based on your actual tax bill, because they scared you run away without paying your taxes. And since it is the end of the year, many platforms are running SRS promotions. For example, Endows is giving $50 off your Endows fee for SRS investments when you sign up using my link. FSMOne is also offering up to $200 when you invest your SRS money with them. Sign up links down below, yeah? Quick pause. If you are looking for the best brokers to kickstart your investing journey, check out Interactive Brokers. You will enjoy one of the lowest fees in the industry at just 35 cents per trade on the US stock market. It also offers Ireland domicile ETFs, perfect for saving on dividend withholding taxes. Plus, it also comes with free company research tools, so you can make smarter investing decisions. Feel free to use my Interactive Brokers link to open an account and start investing today. Alright, let's get back to the video. Next, if you have Heisho a few months ago and just got a kid, congrats, you will receive the Parenthood Tax Rebate. The amounts that you got will depend on which child this is. For your first child, the rebate is $5,000. For the second child, it increases to $10,000. And for the third and each subsequent children, it jumps to $20,000. Voila! Now, unlike tax reliefs, which only reduce your chargeable income, the Parenthood Tax Rebate actually directly offsets the tax that you have to pay. So, for example, if your original tax bill was $4,000, a $5,000 Parenthood Tax Rebate will instantly bring it down to $0. Then the remaining unused $1,000 balance will keep carrying forward until it is fully used up. This is a one-time rebate per child, and it is shared between the parents. For example, if it is your first child, both you and your spouse get a combined total of $5,000. By default, IRS splits it 50-50, but you can also transfer any portion to your spouse. This is very useful, especially if one parent isn't working. So the working parents can take the full rebate and make sure none of it goes to waste. While we are on the topic of children, let's move on to the next set of relief that you can claim as a parent, starting with the qualifying child relief. To qualify, your child must be below 16 years old or are still studying full-time in a recognized school and is earning $8,000 or less in the year. That income limit used to be $4,000 but has since been raised, which is helpful for kids who take on part-time jobs or internships. So as long as your child meets these conditions, either parent can claim the $4,000 relief or $7,500 relief if your child has a disability. And just like the Parenthood Tax Rebate, the QCR can be shared between parents. Though, if you wish to optimize this, it's best to give the relief to the higher income parents so the tax savings can be maximized. Next, we have the Working Mother's Child Relief. This is one of the most powerful tax reliefs available to parents. That's because in the past, the amount of relief a mother could claim under this was based on the percentage of her earned income, and the percentage stacked for every child that you had. So if you have 3 kids, the total reliefs could easily add up to tens of thousands of dollars. Obviously, the government wanted to incentivize moms to also go and work lah. However, from the year of assessment 2025 onwards, the Working Mother Child Relief has been adjusted. For children born in 2024 or later, the Working Mother's Child Relief is now a fixed dollar amount. Under this new structure, a working mother can claim $8,000 for the first child, $10,000 for the second child, and $12,000 for the third and every additional child. But just to be clear, if your child was born before 2024, the old percentage-based system will still apply for that child. To qualify, you simply need to be a working mother. And unfortunately, this relief cannot be shared with the father. Only the mother can claim it. This is also why tax planning becomes important, because you want to allocate the other child-related reliefs properly between you and your spouse to ensure nothing is wasted. Also, do take note that the combined amount of relief that you can claim from the Working Mother's Child Relief and the Qualifying Child Relief is capped at $50,000 per child. Moving on, under the Grandparent Caregiver Relief, if you are a working mother and your kid is 12 years old and below, and your parents, grandparent or in-laws are helping to take care of your kid, aka free childcare, you qualify for $3,000 tax relief. But here's a question, is this relief stackable for each child that you have? The answer is no. So it doesn't matter whether your parent is taking care 2 or 20 of your kids, the total relief is still $3,000. Now, there are a few conditions to take note of. First, the caregiver must either be not working or must not have earned more than $8,000 in that year. If they earn more than that, oh, then too bad, they won't qualify as a caregiver for this relief. Second, no one else should be claiming the Grandparent Caregiver Relief on the same caregiver. So, for example, if your sister has already claimed the relief on your mother, then you cannot claim the same relief on your mother as well. In that case, you will have to choose another eligible caregiver law. And third, this relief can only be claimed by the mother. The father cannot claim it. Next, we have the Parents Relief and Handicapped Parent Relief. Basically, this relief is to encourage us to be filial children lah. To qualify for the Parents Relief, your parents must be 55 years old and above, and must not have earned more than $8,000 in that year. Though, this criteria won't apply if they are handicapped. The amount of relief you can claim depends on whether your parents is living with you. If they are staying together with you in the same household, you can claim $9,000 per parent. If they are living on their own, the relief is $5,500. And if the parent is handicapped, the relief amount is even higher, going up to $14,000 if they live with you, or $10,000 if they live separately. Now, even though it says that your dependent is living in a separate household, you need to have incurred $2,000 or more in supporting him or her, IRS doesn't need you to keep any receipts or submit proof. You simply need to declare that you have supported them and ding, you qualify for the relief. Though, note that you can only claim for up to 2 dependents, yeah? So you can't just ask the whole kampung to live with you and claim on everyone. This relief is shared between siblings. So if your mom is living with you and your brother, both of you can claim a combined total of $9,000. Then how you want to split it is up to you guys lah. One important thing to note is that it's not possible to claim the parents' relief and spouse relief on the same person. So, for example, if you're claiming spouse relief on your wife, then your children cannot claim the parent relief on their mother. In that case, it is financially better to claim the parents' relief since it gives a much higher $9,000 as compared to the $2,000 from the spouse relief. Next, we have the spouse relief, which is meant for taxpayers who are supporting a non-working spouse. So if you are working and your spouse is a stay-at-home tai-tai or a stay-at-home husband, then this is for you. To qualify, your spouse must not have an annual income of more than $8,000. But if your spouse is handicapped, then this income limit does not apply. The amount that you can claim is $2,000 for a non-working spouse or $5,500 if your spouse is handicapped. Again, as mentioned earlier, you can't claim both the spouse relief and the parent relief on the same person. Next, when you donate to any charity that is an approved institution of a public character, you can get a 250% tax deduction on the amounts that you donated. So, for example, if you donate $1,000, your chargeable income will be reduced by $2,500. But here's something important to remember. You can't profit from donating, since the amount you donated out will always be higher than the amount of tax savings you get back. For example, if you're earning $100,000 and you donate $10,000, you will still end up with an accessible income of $75,000, which will attract $3,000 worth of income tax. So in a way, this tax relief is more of a side benefit that you will get if you're already planning to give to charity anyway. You get to support a cause that you care about and at the same time, reduce your taxes. Do note that in order for your donation to qualify, it must be made to an IPC approved charity. Donations to charities, crowdfunding campaigns, or private fundraisers will not qualify for the tax deduction. Next, we have the NSman Relief. This applies to all Singaporean males who have completed their national service. The amount of relief you get depends on your NS status and whether you perform NS activities in the past year. If you are an NS man who did not perform any NS activities in the year, you get $1,500 in tax relief. But if you did perform NS activities for that year, such as ICT or IPPT, the amount goes up to $3,000. Also, if you are an NS key appointment holder, the relief is even higher. Besides that, if you are a wife or parent of an NS man, you will also receive a relief of $750. Though, note that the NS man parent relief and NS man wife relief can't be stacked. For example, if you are a mother and both your husband and your son are NS men, you will still only get a $750 relief. Similarly, if you have 3 sons who are all NS men, you will still only get $750 worth of relief. But what if you have 3 husbands who are all NS men? That one is a different topic altogether. Next one on the list is life insurance relief. Although honestly, most Singaporeans today will not qualify for it. That's because this relief will only apply if your total CPF contributions for the year is less than $5,000. So this relief is more for the super low income workers or foreigners since they don't have CPF. Additionally, this relief is only for the life insurance. So it doesn't cover accident insurance, hospitalization insurance, health insurance, and so on. But if you do qualify, you will be able to claim up to $5,000 in relief for the life insurance premiums that you have paid. Next, we have the course fees relief, which is meant to encourage Singaporeans to upgrade their skills. Under this relief, you can claim up to 5.5k per year for courses, seminars, or conferences that are relevant to your current job or future employment. This relief covers things like aptitude test fees, exam fees, registration fees, and even tuition fees. So if you took a certification related to your field, such as ACCA, CFA, CDL, IT courses, and so on, they will qualify, as long as the course is directly relevant to the work that you are doing or intend to do. On the other hand, courses taken for personal interests, such as photography, language, and so on, won't be eligible. Also, if you have used your SkillsFuture credit to pay for that course, that portion is also not claimable. Last but not least, we have employment expenses. This is something that many people forget that they can claim, especially if they work from home. So if you have incurred expenses in the course of doing your job and your employer does not reimburse you for them, you can claim them as tax-deductible expenses. For those working from home, this can include a portion of your electricity bill, Wi-Fi, as long as these were purchased specifically for work purposes. Additionally, you can also claim expenses that are directly related to carrying out your official duties. For example, if you entertain clients, you can claim the client's portion of the expense, but not your own. You can also claim professional subscriptions and even work-related travel. Though, note that travel between your home and your office is not claimable, since that is considered as personal commuting. The key conditions are simple. The expense must be necessary for your job, and it must not have been reimbursed by your employer. If the company already paid you back, then you cannot claim it again. Also, note that if you plan to claim employment expenses, make sure you keep your receipts and records for at least 5 years, in case IRS asks for them. So that was a full breakdown of the different ways you can legally reduce your income tax in Singapore. If you want to dive deeper, IRS has a super useful page where you can filter the reliefs and rebates that apply to you and see exactly how much you can save. Anyway, hope you found it useful. Like, share and subscribe as I'll be posting new videos every week.